Welcome back to the Deep Dive. This is where we take those really dense financial reports, the ones that run hundreds of pages, and turn them into clear, actionable insights just for you.
And today we're tackling a real giant in the Turkish energy landscape, AYGAZ.
Absolutely.
Mhm.
And the source material today, it's pretty comprehensive. We've got the consolidated financial statements and the activity report. Both cover the 9 months ending September 30th, 2025.
And a really crucial point right at the top, all the data we're discussing today is inflation adjusted. Every figure you hear, all those billions of Turkish lira, they're presented in bin TL. That means thousands of lira. But critically, they're adjusted to the purchasing power as of September 30th, 2025.
Right, using the TMS 29 standard for high inflation accounting.
Exactly. So when we talk about growth or contraction, we're talking real terms, not just numbers being pushed up by inflation. It's vital for understanding the actual performance.
Couldn't agree more. That adjustment is fundamental. So our mission today, specifically for you, the individual investor, is to kind of decode IGAS. They have this dual nature, right? On one hand, the core LPG business, distribution,
The operational side.
and on the other, this strategic financial powerhouse identity. We need to figure out where those margin improvements are really coming from, why they shifted from, basically cash neutral to strongly cash positive.
And how those big non-LPG investments are actually playing out on the bottom line. We're going to cover it all: the corporate structure, the subsidiaries, quite a web there, the operational side, the revenue picture, which is interesting.
Not only interesting.
And then drill down into liquidity, debt, future plans. If you're following IGAS, thinking about Turkish energy, or just want a masterclass in how a company can navigate this kind of environment, well, you're in the right place.
Okay, let's dive right in then. All right, let's unpack IGAZ itself. I think for most people in Turkey, IGAZ means that orange gas cylinder for cooking or heating. But the reality is much bigger, isn't it?
Yeah. Oh, much bigger. It's a vast operation, really vertically integrated. So yes, the core is liquefied petroleum gas, LPG, supply, storage, bottling, distribution, the whole works.
And that covers different types of LPG use.
Exactly. You've got the cylinders, what they call tüplü. Then there's bulk gas, AYGAZ, that goes to, say, industrial customers. And of course, AYGAZ, the fuel for vehicles, which is a huge market in Turkey. And they do this both domestically and increasingly internationally.
You mentioned vertical integration. So they're not just distributors, they actually make the equipment.
That's a key part of it. They manufacture LPG cylinders, those big bulk tanks, even the regulators, all at their plant in Gebze.
Yeah.
This gives them, control over quality, supply chain security. It's a big advantage.
And the scale of your physical operations must be enormous. Can you give us a sense of that footprint as of, say, September 2025?
It's immense. Think about it. 5 marine terminals just for bringing in and storing LPG, then another 5 dedicated filling facilities separate from the terminals, add 8 large distribution centers spread across the country. But the real dominance, the barrier to entry for anyone else, is that distribution network. They work with 1,980 bottled gas dealers and 1,907 AYGAZ stations. That kind of reach, that physical presence, it's incredibly hard to replicate.
It gives them huge market control. And their HQ is in Istanbul, the AYGAZ Han in Zincirlikuyu. So that's the core business LPG top to bottom with a massive physical network.
Okay, so if that's the core, the trunk of the tree, then the subsidiaries and affiliates are like these strategic branches. Some support the core, others are about diversification. Let's start with the ones they own 100%. Shipping seems important.
Yeah, I see several tanker operations listed here. Anadolu Hisari, Kandeli, Kuzgunkuk, Kuleli, all Turkish flagged. But there's an international angle now, too.
Absolutely. They're definitely pushing outwards in maritime. They bought an LPG vessel, the BBAC, back in November 2024, and that led straight to setting up BBAC Shipping SA, registered in Panama. And on top of that, there's Kuleli International Supply and Shipping FZCO, based in Dubai. This isn't just about moving their own product more efficiently. It signals they want to control more of that international supply chain, maybe even capture some global shipping profits.
Makes sense. And domestically, they have other businesses that seem to fit closely with the core, like AKBA.
Right. AKBA handles marketing for LPG, but also retail fuel and lubricants. So clear synergies there. Then there's AYGAZ Doğalgaz, that's their arm in the natural gas wholesale and transmission market.
Okay.
And maybe a bit less, obviously, Balkaynak, which is in the water trade business. That actually came into the group via one of the tanker companies years ago. So some domestic diversification, but honestly, these are relatively small compared to the big strategic investments. That's where the real financial story is.
Okay, let's talk about those. The name that comes up again and again is AYGAZ, Energy Yatırımları Araç. Why is this so critical?
EYAS is, well, it's fundamental to understanding AYGAZ's financial strength. AYGAZ owns 20% of EYAS, and EYAS, in turn, owns a massive 46.40% stake in Tüpraş.
Turkey's main oil refiner.
Exactly, the dominant player. So through EYAS, AYGAZ effectively gets a very significant slice of the profits from Turkey's primary refining operation. As we'll see later when we look at the numbers, this isn't just a profit driver, it is the main profit driver for AYGAZ.
So a huge chunk of their financial health is tied directly to the performance of Tüpraş and the wider refining sector. It's like a built-in portfolio diversification.
It is. It provides a massive cushion. Now, another big strategic move, and this one is more recent and outside energy, is AYGAZ.
Right, the logistics and delivery company. They have a 27.50% stake.
Yes. This came about from merging their own Sendeo iCargo operations with Equal Express Cargo's activities late in 2024. The name change to AYGAZ was formally registered in June 2025.
It seems logical on the surface. AYGAZ already runs a huge distribution network for LPG. Why not leverage that for general cargo?
That's clearly the thinking. They see their logistics expertise as an asset they can, apply elsewhere. It's an attempt to tap into the high growth potential of the e-commerce delivery market.
But is it working? I mean, logistics is notoriously competitive, often with thin margins. Is this a smart use of capital compared to their energy holdings?
That's the big strategic question, isn't it? Management is betting that their existing know-how gives them an edge. But as we'll see, AYGAZ is currently loss-making. They're essentially using the very stable, very large profits flowing from AYGAZ to fund this venture.
So they're absorbing early losses, hoping for long-term scale and profitability in logistics.
Precisely. It's a long-term play funded by the core energy investments.
Okay. There's also a real estate joint venture with OPIT OAGM focusing on fuel station properties. That seems straightforward synergy. And then there's Bangladesh.
United AYGAZ LTG Ltd. That's their 50% joint venture there. This is their main international growth push for the core LPG business itself. Supply, filling, distribution in Bangladesh, a market with potentially huge growth.
How established are they there?
They've made good ground. Reports mention 240 dealers and around 13,000 sales points. It shows a very deliberate strategy. Find a high-potential developing market and replicate their successful Turkish model. Hashtag 1.3 corporate governance and personnel.
Okay, let's shift to governance. Ownership looks very concentrated, which isn't unusual for Coast Group companies.
No, it's typical. Very stable, but tightly held. Coast Holding has just over 40%, 40.68% to be exact. And then there's LPGDC, the Liquid Petroleum Gas Development Company, with 24.52%.
So between them, that's over 65%, leaving only about 24% for the public float.
Right, which means Coast Holding's strategic direction really dictates things. Minority shareholders are essentially along for the ride, relying on Coast stewardship.
And that stewardship seems well regarded. I see a corporate governance rating score of 9.67 as of June 2025. That's quite high.
It is. It signals a strong commitment to transparency, compliance, international standards. That's important for attracting institutional money.
What about the board itself? Any diversity notes?
Yes, actually. It's an 8-person board, and 2 members are independent female directors, Gule Barbarosalu and Neslihan Tombul.
So that's, what, 37.5% female representation? That's pretty good for a major industrial company in the region.
It is. It shows they're paying attention to governance best practices there, too.
Now, personnel numbers. There's something interesting here. The head count at the end of September 2025 was 12,284. That's actually up slightly from the end of 2024.
Right, up from 1,256, but
the average number of employees over the whole 9-month period dropped quite a bit, from 1,537 in the first 9 months of 2024 down to 12,277 in the same period of 2025. What does that tell you?
that points very clearly to some significant restructuring or efficiency drive that probably happened in late 2024 or very early 2025. They likely reduced the workforce substantially, maybe layoffs, early retirements, cutting management layers.
And the slight increase by September suggests they've now stabilized at this leaner level.
Exactly. The big drop is in the average over the period, showing the reduction happened earlier. The end period number suggests they've settled into this new, more efficient structure, and this likely plays a big role in the improved margins we're about to discuss.
Makes sense. Fewer people doing the work more efficiently, potentially. And the top management, they seem to be rewarded for this. Their total benefits package went up.
It did, increased in real terms to about 70.8 million TL for the 9 months, compared to 65.4 million TL the previous year.
which you'd expect if performance improved dramatically.
Often, yes. Compensation, especially at the top, is frequently linked to hitting performance targets. And given the big jump in operating profit and net income we'll see, you could argue they delivered those results, justifying the increase.
Okay, let's get into the core financials. And we start with something that looks, well, a bit concerning at first glance. The total revenue, the zero, actually went down significantly.
Yes, and remember, this is inflation adjusted. So revenue dropped from 77.3 billion TL in the first 9 months of 2024 to 64.8 billion TL in the same period of 2025. That's a real decrease of about 12.5 billion lira in spending power terms.
A substantial real contraction in sales activity.
Yeah.
How does that fit with their dominant market position? What's going on there?
It suggests either the overall domestic LPG market itself shrank in real terms, or perhaps AYGAZ made a strategic decision to shed some lower margin business, or maybe a mix of both. Total LPG sales volume overall was 1.777 million tons for the 9 months.
Okay, let's look at domestic sales. Where did that volume land?
Domestic retail sales were 781,000 tons, and the split is revealing.
Mm.
AYGAZ, the vehicle fuel, was the big one at 577,000 tons. TUPLUGAZ, the bottled gas, was much smaller at 171,000 tons.
So the autogas market is where the volume is, but maybe that's where the pressure was felt. More competition, maybe?
It's likely. It's a high volume but competitive segment. The overall contraction probably hit their hardest, suggesting a tougher domestic environment.
But crucially, the reports highlight something that pushes back against this domestic weakness: international sales.
Absolutely critical. This is the counter story. While domestic activity might have cooled, their foreign LPG sales volumes surged. They went from 494,000 tons in 9M 2024 up to 661,000 tons in 9M 2025.
That's a big jump, about 34%.
Huge jump. And even more importantly, these sales bring in hard currency. We're talking $391 million in revenue from those international sales, up from $299 million the year before. In an environment like Turkey's, that inflow of dollars is incredibly valuable. It stabilizes things.
Okay, one more point on revenue before we get to profit. The excise tax, the OTV, it's included in that big revenue number, but it's just a pass-through, right?
Completely. And it's massive.
Yeah.
For 9M 2025, the OTV collected and passed on was nearly 10 billion TL, down from almost 12 billion the year before, which kind of tracks the revenue dip.
So as an investor, you need to mentally subtract that.
You really do. If you see 64.8 billion TL revenue, but 10 billion of that is just tax flowing through, the company's actual operational revenue, the money they have to work with, is closer to 54.8 billion TL. You need to look at that net figure to understand their real scale and efficiency.
Right. Now, for the really surprising part, despite that nearly 13 billion TL drop in real revenue, their gross profit, the brute car, actually went up slightly, from 6.56 billion to 6.78 billion TL.
This is where you see the operational strength shine through. Revenue down, gross profit up. That can only mean one thing: a significant improvement in the gross profit margin, the brute car margin.
And the numbers show that clearly. It jumped from 8.5% in 9M 2024 to 10.5% in 9M 2025.
A 2 percentage point jump in gross margin is huge in this kind of business. It tells us they managed their costs exceptionally well, maybe got better deals on LPG supply, maybe benefited from currency moves on imports, or they successfully shifted their sales mix.
Selling less of the low-margin stuff and more of the high-margin, like those international sales.
Exactly. Probably a combination of both. Better cost control and a more profitable sales mix, especially leaning on those growing dollar-denominated international sales.
And that improvement flowed straight down the income statement. Core operating profit, AYGAZ Faaliyat Kardia, saw a dramatic increase.
Dramatic is the right word. It went from just 590 million TL in 9M 2024 to over 1.54 billion TL in 9M 2025. It nearly tripled in real terms.
Wow. So the operating profit margin, Faaliyat Karmarjo, went from
a pretty thin 0.8% to a much healthier 2.4%. Remember that personnel reduction we talked about?
Yeah, the efficiency drive.
That, combined with the stronger gross margin, meant they kept a much bigger slice of the profit at the operating level. It shows the core business of buying, handling, and selling LPG became substantially more profitable, operationally speaking.
And the bottom line? Net income.
Net income attributable to AYGAZ shareholders also saw a very healthy jump. It rose to 2.75 billion TL, up from 1.76 billion TL in the previous period. So the net profit margin, net car margin, climbed from 2.3% to 4.2%.
So more than doubled. What does that mean in practical terms for someone holding the stock?
It means significantly more profit backing each share. Earnings per share, or EPS, jumped from about 8 lira per share to over 12.5 lira per share, again, in real inflation-adjusted terms. The company is generating much more value per share, even with lower overall sales. But this leads us to the EYA factor again. Hashtag tag 2.3, the EYA's effect and segment performance.
Right. Let's unpack that 2.75 billion TL net profit. How much of that actually came from selling LPG, the core operations we just discussed, versus how much came from that EYA's investment?
This is the crucial distinction. The income they recognized from all their equity method investments combined was about 1.815 billion TL. But EYA issue alone accounted for a massive 1.815 billion TL of profit contribution.
Wait, hang on. EYA contributed 1.8 billion, but the total from equity investments was 1.66 billion. How does that work?
Ah, good catch. It means other equity investments, like AYGAZ perhaps, were actually loss-making on that line, partially offsetting the huge gain from EYA.
Okay, so EYA brought in 1.8 billion. The total net profit was 2.75 billion. That means what? Roughly 66% of AYGAZ's consolidated net profit didn't come from selling gas cylinders or autogas.
That's the essential takeaway. Roughly two-thirds of their reported bottom line comes from that strategic investment in the holding company linked to Tuprush. The LPG distribution business is running much more profitably now, generating maybe around 1.2 billion in profit before the EYA's effect and other factors.
Still a good improvement.
A very good improvement on its own. But the sheer scale of the EYA's contribution defines their overall financial result and stability. It's their financial bedrock.
But doesn't that concentration create its own risk? If something hits the refining sector hard, policy changes, global margin collapse, AYGAZ's profits could plummet, no matter how well they manage the LPG side.
It absolutely introduces that dependency risk. But look at how they're using it. It acts as a massive financial buffer and, importantly, a source of funding for diversification. Take AYGAZ.
The logistics venture.
Right. It reported an operating loss contribution of 273 million TL in these 9 months. For a standalone logistics company, that might be a serious problem.
AYGAZ can absorb it.
Easily, because the billions flowing in from EYA cover that loss many times over. The strategy seems clear. Use the reliable, high-margin cash cow of the refining investment to fund the growth and the initial losses of potentially high-growth ventures like logistics and the Bangladesh operation.
So EYA enables the diversification strategy. Makes sense. One last technical point on the profit side. This monetary position loss from the inflation accounting. 450 million TL. Can you explain that simply?
Okay, TMS 29. In high inflation, holding cash or things easily converted to a fixed amount of cash, like receivables, means you lose purchasing power over time. Inflation erodes the value. So the accounting standard forces companies like AYGAZ, which holds significant net monetary assets, more cash and receivables than monetary debts, to recognize this erosion of value as a loss on their income statement. It's a non-cash charge, basically saying inflation ate away this much of the real value of your cash holdings. It was 450 million TL in this period. It's a reflection of the challenging economic backdrop.
Okay, let's shift gears from profit to the balance sheet and cash flow. And the big headline here, especially in today's world, is that AYGAZ is net cash positive. That sounds incredibly strong.
It is. It means they have more cash and cash equivalents than total financial debt. It's a fortress balance sheet, really. Their cash and equivalents, Nakit Benzerleri, stood at nearly 6 billion TL at the end of September 2025.
6 billion TL in cash. Wow. Where are they keeping it? Is it just sitting in a current account?
Mostly no, they're actively managing it. About 5.7 billion TL of that was in time deposits. They're earning interest on it.
Okay. And the report gives details on those interest rates. That tells you something about their treasury management.
It does. They were earning an average of about 40.7% on their Turkish lira time deposits, which is, very high, reflecting the interest rate environment in Turkey. But on their US dollar deposits, the average rate was much lower, around 2.9%.
So they're aggressively chasing yield on the lira portion, trying to beat inflation while keeping some safer, lower yield dollar reserves.
That seems to be the strategy. Maximize the return on domestic cash while managing currency risk. That 40% yield on billions of lira is a significant contributor to their overall financial income, separate from operations.
The really impressive story, maybe the most positive single item in the whole report, is the turnaround in cash flow from operations, CFO.
Absolutely massive improvement. This signals real operational health, not just accounting profit. In the first 9 months of 2024, they actually burned cash from operations, a net outflow of 102 million TL.
So operations were costing them cash.
Right. But fast forward to the first 9 months of 2025, a complete reversal, a net cash inflow from operations of almost 1.98 billion TL.
That's a swing of over 2 billion lira. What drove that? Better margins.
Better margins helped, but it screams improved working capital management. Collecting cash from customers faster, managing inventory better, maybe negotiating better payment terms with suppliers. That profit improvement we saw is turning directly into cold, hard cash in the bank. That's what investors love to see.
And what are they doing with that cash? Is it just piling up, or are they investing?
They are investing. CapEx, or investment expenditures, increased to about 1.1 billion TL in the period.
Where's that money going?
Primarily into maintaining and strengthening the core business. Things like renewing the cylinder fleet, modernizing equipment and facilities. Plus, there is the acquisition of the Osmane plant mentioned. They're using that strong internal cash flow to reinvest in their physical assets, keeping that operational moat wide and deep. Hashtag 3.2 debt and borrowing ratios.
Okay, let's look at the other side of the coin. Debt. We know they're net cash positive, so overall leverage is low. The net financial debt to equity ratio is actually negative 4.7%.
Right, meaning cash exceeds debt. And their liquidity ratios back this up. The current ratio, that's current assets divided by current liabilities, is holding steady at 1.4. That's very comfortable, showing they can easily cover their short-term obligations.
But they do have some borrowing. Total short-term financial debt actually increased a bit to 2.1 billion TL. What kind of debt is it?
Mostly bank loans. And here's where their strategy gets interesting again. The vast majority of that short-term debt, about 1.9 billion TL worth, is denominated in US dollars.
Ah, so they're borrowing in dollars to take advantage of lower interest rates compared to lira.
Almost certainly. You see, the rates on their dollar deposits were under 3%, while lira deposit rates were over 40%. Borrowing rates would show a similar huge gap. So borrowing in USD massively cuts their interest expense.
But it introduces currency risk again. If the lira weakens, the TL value of that dollar debt goes up.
Exactly. It's a trade-off. Lower interest costs versus higher currency risk exposure. They must feel confident they can manage that risk through other means, which we'll get to.
How are they managing their day-to-day working capital flows, like receivables and payables?
Very effectively, it seems. Trade receivables money owed to them by customers actually decreased, down to 4.5 billion from 5.1 billion. That helps cash flow massively.
Getting paid faster.
Right. And trade payables money they owe to suppliers stayed relatively stable, around 5.6 billion TL. So, strong collections, stable payments out, that's good working capital discipline, freeing up cash. Hashtag 3.3 equity changes and dividend policy.
Now let's look at the shareholders' equity. The total equity belonging to the parent company actually dipped slightly, from 65.6 billion TL at the end of 2024 to 64.5 billion TL at the end of September 2025. Why would it go down if they made a 2.75 billion TL profit?
The dividend payout, it's all about the dividend. While they earned 2.75 billion in net profit during these 9 months, the dividend they paid out in April 2025, based on 2024 profits, was larger in real terms.
How much did they pay out?
The gross cash dividend was 2.76 billion TL. But remember, inflation accounting. Adjusted to September 2025 purchasing power, that payout was effectively worth 3.14 billion TL.
So in real terms, the dividend distribution exceeded the profit earned during the period.
Correct, which means the excess came from previously accumulated retained earnings, causing that slight dip in the total equity figure when measured in constant lira.
What does that tell shareholders?
It signals a very strong commitment to returning cash. The payout was substantial, 12.55 TL gross per share. Their official policy aims for distributing at least 50% of distributable net profit, market conditions allowing. This payout shows they're serious about that, maybe even exceeding it when cash flow allows, prioritizing shareholder returns.
Okay, let's dig into the risks, often hidden away in the footnotes. The dip not lar. There seems to be a significant one related to natural gas pricing.
Yes, this is important. Their subsidiary, AYGAZ, is part of an ongoing arbitration case involving ACFL and Gazprom about natural gas price revisions. It's a complex dispute.
And AYGAZ has set aside money for it.
They have. They've booked a short-term provision of just over 805 million TL. That's their current best estimate of the potential financial hit from this arbitration. It's roughly $19.4 million US. It's a known risk provision for, but it's definitely something to watch in the natural gas segment.
Right. Then there are these TCO figures. Collateral, pledges, mortgages, guarantees. What are these and why track the total?
TK Teminot, Reinhin, Apotek, K-Fellet. It represents the total value of guarantees and collateral AYGAZ has provided, often to secure loans or obligations for themselves or sometimes related parties. A high or rapidly increasing TAK figure could signal hidden risks.
So what's the trend here for AYGAZ?
It's actually positive. The total TIK they've provided decreased quite substantially. It went down from 5.25 billion TL at the end of 2024 to 4.05 billion TL by September 2025.
A drop of over $1 billion lira.
Yes. That suggests management is actively working to reduce these off-balance sheet exposures and de-risk the company's overall financial posture. That's a good sign.
And just confirming, they're meeting their regulatory requirement to hold minimum fuel stocks.
Yes, the national stock obligation. They state they are compliant, holding at least 20 days' worth of average daily sales as required national petroleum stock. Standard operational procedure for them. Hashtag #tab 4.2, currency risk management. Currency risky.
Okay, back to currency risk, the currency risky. We know they borrow in dollars, so what's their overall net position?
As of September 2025, they had a net foreign currency liability position of about 1.87 billion TL, meaning their foreign currency denominated debts and payables exceeded their foreign currency assets and receivables by that amount.
So they are exposed if the lira weakens further. How do they manage that, given its size?
They use a few layers of defense. The main one is what they call a natural hedge. Because the cost of the LPG they import is mostly in dollars, they try to reflect changes in the exchange rate directly into their lira selling prices.
Cast the cost increase onto the customer.
Essentially, yes. It cushions the blow from a weaker lira on their margins. But that takes time and depends on market conditions.
Let's for the next layer.
They also consider their LPG inventory itself as a kind of hedge. Their stock, valued at 1.76 billion TL, is a physical asset whose replacement cost rises if the lira falls. So the value of the stock sort of offsets the increased value of the FX debt.
A bit conceptual, but okay. Are they using financial instruments too? Forwards, options?
Yes, the report mentions they started using forward contracts more actively in 2025 to lock in exchange rates for future transactions. This provides a more direct financial hedge.
So after all that price adjustments, inventory value, forward contracts, what's their actual sensitivity? If the dollar strengthened by, say, 10% against the lira.
The sensitivity analysis in the report suggests that a 10% USD appreciation would result in a net loss of about 204 million TL hitting their income statement after considering the hedging effects.
So still a significant impact, but maybe manageable relative to their overall profit.
Exactly. It's not zero, but it's quantified, managed, and seems within reasonable bounds given their profitability. They're clearly working to reduce it further with those forward contracts. Hashtag tagged 4.3 post-balance sheet events and future expectations.
Now things get even more interesting after the reporting period ended on September 30th. There were a couple of major events in October 2025.
Yes, two significant cash inflows occurred just after the balance sheet date, but before the report was published. First, they sold off a non-core asset.
Their headquarters building.
Part of it, they sold their 43% share in the General Directorate building complex. It went to an affiliated company, Temel Ticaret AYO, for a hefty price, 1.245 billion TL.
Injecting over $1 billion in cash straight away.
Precisely, monetizing real estate that wasn't critical to the core energy operations.
And the second event reinforces the EYA story.
It does. Also in October, they received a huge cash advance dividend payment from EYA, totaling 1.015 billion TL.
So the EYA profit engine isn't just an accounting entry, it's delivering massive amounts of actual cash quickly.
Exactly. These two October events combined pumped over 2.25 billion TL of fresh cash onto AYGAZ's already strong balance sheet right after the period ended.
Okay, finally, what's management's outlook? What do they expect for the rest of 2025?
Their guidance seems focused on stability and maintaining market share rather than aggressive volume growth. For AYGAZ, bottled gas, they expect full-year sales between 220 and 230,000 tons, and they aim to keep their dominant market share there between 41% and 43%.
And for the bigger volume segment, AYGAZ.
For AYGAZ, they're projecting sales between 755 and 785,000 tons for the full year, targeting a market share of 22% to 23%.
So steady as she goes, Focus on holding their position and presumably maintaining those improved margins.
That seems to be the picture. Optimize the core business, keep the market share, manage costs effectively, and let the financial investments provide the firepower for dividends and diversification.
It really paints a picture of a mature, efficient operator strategically using its investment income. Hashtag outro.
Exactly. They're leveraging that financial strength from EYU to run a leaner, more profitable LPG operation while also funding those big bets on logistics and international expansion.
Okay, let's try and synthesize this. This deep dive into AYGAZ's first 9 months of 2025 shows a company that's much more than just an LPG distributor. It's really operating as, well, almost like an investment holding company with a very efficient energy arm attached.
That's a good way to put it. That initial worry about the drop in real revenue was completely overshadowed by, first, that really impressive operational turnaround, tripling core operating profit through better margins and cost control, leading to that massive positive swing in operating cash flow.
Huge operational achievement internally.
Huge. And second, of course, the continued massive contribution from the EYX investment, providing something like 2/3 of the net profit and acting as a huge stabilizer. Add to that the fortress balance sheet, net cash positive, strong liquidity, and that clear commitment to big dividend payouts.
So for you, the investor, what's the final takeaway? AYGAZ seems incredibly well-positioned, strategically sound. But is there a vulnerability? A provocative thought to leave you with?
I think the key question is about that reliance on EYX. It's their superpower right now, funding everything. But what if external factors significantly reduce that contribution? Say, a sustained downturn in global refining margins, or maybe regulatory changes impacting toothbrush.
Could the core LPG business, even with its improved profitability, sustain the current high dividends and continue funding Cole Gelson's losses and the Bangladesh expansion on its own?
That's the critical balance. How quickly can those new ventures, logistics and Bangladesh, start contributing positively to offset any potential future weakness from the EYX side? Their ability to successfully mature these investments becomes crucial for maintaining this powerful but potentially reliant dual identity.
And maybe a related question. With all that cash flowing in post-period, will they use it to more aggressively hedge or pay down that remaining USD debt to further reduce currency risk? Or will they double down on investments?
Exactly. Watching how they allocate that capital risk reduction versus growth investment will tell you a lot about their priorities going forward. It's a fascinating strategic balancing act in a complex environment.
It really is. AYGAZ is definitely more than meets the eye, far more complex than just an orange gas cylinder. This has been incredibly insightful. Thanks for joining us on the deep dive.
A real pleasure. Lots to think about there.
Indeed. Until next time.